Hi, everybody. George Veter, president of Veter Financial, welcoming you here at the end of March to a quick video blog to update you on what's been going on in the market, give you my perspective, and then give you some expectation based on where I sit. First of all, we had a very active week. Yesterday, the Fed announced their policy for March, and interest rates, or the Fed overnight fund rate, went up as was expected, 0.25%. Which is a smaller rate hike than many had feared before the Fed meeting. The Fed also changed his language. When I say the Fed chair would be Jerome Powell, to include that we're nearing the end of this rate hiking cycle. Another thing that the Fed addressed yesterday was the failure of Silicon Valley Bank. SVB was kind of like a out of left field event in our economy that drove the markets down for a short period of time. And when it felt like that crisis was being contained, the bank stocks have been coming back up. What they did do is they did not manage their reserve portfolio in a way that would protect them from high withdrawal rates. So just to give you a quick example, lots of the bonds that they had purchased for their reserve requirement were purchased at very low yields 2 years ago, 3 years ago. So they had an average duration of 6 years on their bonds left, and the average yield on those bonds was less than 2%, 1.72, I believe is what I read yesterday in Bloomberg. So they took big discounts in the billions on those bonds, which gave them a liquidity crisis and made them insolvent in the eyes of the FDIC. Now, if those bonds would have been managed correctly and those long-term low-yielding bonds would have been sold at the beginning of this Fed cycle, or at least managed to where the average maturity was lower and lower and the average yield was higher, which we did for our clients. Those of you that are watching this that are our clients, you remember that we put you in floating rate bonds and low duration bonds a year ago, because we knew when the Fed started this cycle that short-term bonds would do much better because they keep renewing at the higher rates than long-term bonds trapped in those low rate environments. But if those bond portfolios weren't managed, it created problems. And that's what surfaced in Silicon Valley Bank. Now, the government came out and said, listen, we have this new program, the Bank Term Funding Program. And that means that those assets, like those long-term low-yielding bonds that are meant to be held to maturity, instead of having to sell them if liquidity needs to be raised in a bank to meet its obligations, they now can borrow from the Fed window for up to 1 year, dollar for dollar, against those long-term assets. And that kind of is a way to fill that gap for this situation happening again. In reality, when these things happen, the strong majority just absorb the weak minority in the banking system. And I think that's what has already happened and will continue to happen. Okay, now the positive in that is that it caused the Fed to realize that there are some cracks in the system based on these aggressive rate hikes. And so it did change the language. It created a probability for a 50 basis point hike yesterday. That probability just was reduced to 25 basis points. And how far the Fed's going to go, some people, we're talking all the way to 6% on the overnight rate, where it is right now at 5%. Now everybody, the bulk of the analyst community is thinking, we're near the end, like 5.25 to 5.50 maybe. So that's about over. So that's that. The recession risk in the market is talked about a lot today, so I thought I should bring that up. First of all, I do not know if we are going to dip into recession. I know that if we do, it's something that we learn about after it's already happened. It's not like we open up the Wall Street Journal and it says we started a recession today. It's after we're beyond those negative quarters, and then after the data is accumulated and then revised multiple times, we're told quarters later that we were in recession. most of the recessions that I've lived through in my 30 years in this business have been extremely minor as far as the market's reaction to it. We just have had a couple of major ones like 2008, but aside from those, they've been very minor. So I'm not really worried about that. The good news is when we look at what we have to be positive about is there's kind of a counterintuitive thought about pessimism in the markets. And that would be that markets have to get very pessimistic before the new bull market can begin. So we know this bear market's getting old, and extreme pessimism is a signpost telling us that it's maturing. In fact, John Templeton, the founder of Templeton Funds and then Templeton Franklin Funds, is one of my heroes in this business. But he said bull markets are born on pessimism. And so if you hear all this talk about recession, that's probably a good thing if history is our guide. Another thing that's on our side is we're in the third year of this presidential administration, and third-year administrations have been very good for the stock market over the years. In fact, we've got our data, for the S&P back to 1925, the S&P average. And on third-year administrative terms, we've only been negative twice. So 91% of the third years have been positive for the market. And the 2 years that weren't were 1931, which was the pit of the Depression, and then 1939 when war broke out in Europe. So every other year has been positive, in large part because we usually have some division in Washington, and we have gridlock or some form of gridlock. So that removes political uncertainty from Wall Street. And so that bodes well for the stock market. And then the last thing I just want to mention is that we have to keep in mind, I think, that capitalism is just a blessing that we're able to invest in. The world wasn't always capitalistic in large part, but now it is. So we get to own the greatest ideas and innovative companies in the world in a diversified manner through a proper portfolio that's designed for us. And we just need to know that that is not an experiment. It is a proven system of wealth creation. And we do have these moments where we get scared, and that's a part of the process, and we have resets, and then we move on to our next bull market expansion. And I believe that we're finding that place. That's my personal feeling right now. We have to trust in the patterns of nature and the patterns of economies. When we're cold in winter, it feels like spring's never going to get here, but spring has always followed winter, and it always will, even when it feels like it's never going to come. Okay, bull markets always follow a bear market. There's never been a bear market that wasn't followed by a bull market. Okay, that's a very dependable pattern and a historical precedence that we need to have faith in so we don't, get too scared as investors when we have these negative moments. I want you to know that I'm grateful that I get to manage money for the people that are represented in this video blog, my client base, Veeder Financial, and our service team here, and the other advisors here that we get to serve. And we consider it, I don't want to make this too trite, but like a sacred responsibility to do the right thing, to maintain disciplines. And even when it's not the easy thing, doing the right thing ultimately always pays off. That's my personal belief. And we manage money and we do financial planning in that way. So we're grateful and never not appreciative of the trust you place in us to maintain those disciplines and to continue to serve you in the best possible way. So I look forward to updating you throughout the year as this kind of an exciting inflection point. Keep yourselves healthy, enjoy your relationships. Let me continue to worry about your money for you. And again, I'm grateful, and I'll talk to you at our next video blog.